morning. My name is Arya Tafira, and I'm one of MBA student in IPMI International Business School. And today I will sharing a little bit about corporate finance, which is one of our courses in IPMI International Business School. Very amazing and best lecturer, Prof Roy Sembel.
Hello, let's discover about corporate finance mind mapping. First is financial management. Financial management is everything we do to achieve the goal of financial management. 1. The goal of financial management is to get significant and sustainable value creation of our research being used. How we do that? And what are the things we need to manage? We manage the capital structure, working capital, asset structure, revenue management, cost management, cash flow management, growth management, risk management. So, it is not only about numbers and money, but also about ensuring the non-numbers variables such as risk management, ethics, and agency theory. These variables we can call good corporate governance principle. Why it is important? Because it can affect whether we can achieve the target numbers or money. 2. Corporation and financial market. Corporation and investor interact each other through financial market. The corporation generates cash from investor either by selling securities, and later on corporate will pay dividend and pay tax to the government. 3. Principal agent problem. As mentioned before, the goal of financial management is to make sure significant and sustainable value creation. In doing so, there is potential conflict between the shareholders and the manager on how to achieve the goal. This conflict or interaction is called principal agent problem, whereby shareholders hire manager to achieve the goal and the manager may not do their best to maximize shareholder wealth. 4. Corporate governance is how we minimize the principal agent problem is by implementing good corporate governance. It is a set of rules and procedures to be followed to ensure the company is managed properly and according to prevailing principle and standard. 5. Stakeholders conflict interest. Each of stakeholders may have different interests and therefore may be conflicting. For example, the shareholders ask manager for higher profit, and to achieve the manager's needs to cut labor costs. However, the union may disapprove and go straight, causing operation disruption. That later may hurt company reputation and decline the revenue. 6. We also learn about ethical behavior. Ethical behavior is behavior in accordance of good ethic and conduct. 7. Value creation. Value creation is process to create value using existing and procured resources to produce more values. It's simply two input resources combined together to create four output products. Last, according to Prof Ramcharan, there are 5 business essentials the CEO needs to manage. That are cash, profit margin, velocity, transaction volume, growth, and customer focus. Time value of money. Time value of money means that a sum of money is worth more now than the same sum of money in the future. The money you receive today is more valuable than money you receive next year. We can assign it as opportunity cost. This theory application of time value of money usually used in mortgage, car leasing, life insurance, time deposit, company valuation, and capital budgeting. There is 2 ways to examine the time value of money. First, future value. We can measure the opportunity cost, or we call interest or I notation. We can measure how much future value of the money we receive today, and this is the formula to calculate the future value. Second, present value. Present value is the value of the money that we can receive in the future by discounting it with opportunity cost or interest. For example, if we are promised to receive $1,000 next year by investing $900,000 today, of course, our opportunity cost of interest is 8% per annum. We can calculate using present value formula whether it's a bargain or not. If the PV is higher than $1,000, that is not a good bargain. Capital budgeting. capital budgeting is planning process for investment in long-term assets. Now that we had covered about two basic tools of evaluation time value of money, it's time to move on more detailed tools in evaluating investment of our capital resource for long-term asset. The investment of capital resource can be in form of purchase of fixed asset for production or buying a shares or equity of other companies. This tools called capital budgeting. And decision of capital budgeting will be accept or reject the investment proposal. And it has several tools such as payback period, NPV, probability index, and most common use internal rate of return. First, payback period. How many years does it take to cover the initial investment? Means how many years it takes for the accumulated incoming cash flow cover the initial investment. The shorter is much better than longer. For example, if we are choose between two projects, Project A payback period is 5 years, while Project B is 3 years, then Project B is better. However, using PBP has weakness since it doesn't consider time value of money. The incoming cash flow is not discounted by required rate of return, and it doesn't consider all cash flow from the project that is outgoing cash flow, incoming cash flow. Therefore, we need to use three measurement tools below. 2. Net present value. The net present value is tools where you measure the time value of money of incoming cash flow by discounting it with required rate of return or opportunity loss. You assign it with term interest or I notation. All cumulative discounted incoming cash flow then subtract with outgoing cash flow or amount of invested cash to generate the incoming cash flow to come up with residual value or dollar. The residual is called net present value. 3. Probability index. Probability index is a tool where you measure the likelihood of coming cash flow to happen. If PI is less than 1, then you reject the project. If above 1, then you accept since the likelihood is almost certain. Below, I means uncertain. Internal rate of return, or IRR, is the tool where you measure discounted incoming cash flow and compare it with the initial investment you made. But instead of using your opportunity loss or interest, or used to call as cost of capital, you discount it using your favorable rate of return or required rate of return. It will be higher rate than opportunity loss or cost capital because you factored other costs into its such probability index, government risk-free rate, and also tax rates. The IRR is basically accounted of variable you deem it fit to value the opportunity loss and other factors that may impact the value of incoming cash flow. Analysis of securities. Securities analysis refers to the method of analyzing the value of securities, like shares and other instruments, to assess the total value of business, which will be useful for investors to make decisions. There are 3 methods to analyze the value of security, which is fundamental, technical, and quantitative analysis. Fundamental analysis is a tool to assess the fundamental analysis in accounting and finance is the analysis of a business financial statement, usually to analyze the business asset, liabilities, and earning, health, competitor, and market. It also considers the overall state of the economy and factors including interest rate, production, earnings, employment, GDP, housing, manufacturing, and management. There are 2 basic approaches that can be used: bottom-up analysis and top-down analysis. Fundamental analysis is performed on historical and present data, but with the goal of making financial forecasts. There are several possible objectives. First, to conduct a company's stock valuation and predict its probable price evolution. Second, to make projections on its business performance. to evaluate its management and make internal business decisions, to calculate its credit risk, and to find out the intrinsic value of the share. In fundamental analysis, we also analyze some factors, which is one is probability, second is liquidity, third is activity and leverage, and market ratio, healthy or not healthy, which is the first is natural level, quality of number, historical trend, industry benchmark, and the composition like DuPont analysis. Besides the above analysis, we also need to assess the quality of its financial numbers, whether it's accurate or less accurate, whether it's audited by a respected Big Four audit firm or not, whether there is possible window dressing, different of accounting practice. Historical trends is also something we need to consider. If the trend is stable and increasing, the better than decreasing. What is the factor behind the trend is also needs to assess. We also need to do industry benchmark to compare how the company perform against its competitor. And lastly, we do a DuPont analysis. DuPont analysis is analysis of important fundamental ratio that has connection to each other. This reflects the overall performance of the company. The ratio used are profit margin ratio, return of asset, and return of equity ratio, and asset turnover ratio. Net present value. First is beta, is a measurement of the volatility of individual share against the market. For example, if beta of one company is above 1, we can say the share price of that company is volatile. Example, beta of PTA is 1.2, meaning if the market move 10% downward, when mostly likely the company share price decline 10%, multiple 1.2. Capital asset pricing model is a tool to measure the relationship between systematic risk and expected return for asset, particularly stock. Weighted average cost of capital is the rate used to discount the incoming cash flow generate. The variables includes in coming up with weighted average cost of capital are cost of debt, tax rate, percentage of debt versus equity, are your cost of equity, and weighted average cost of capital is commonly referred to as the firm's cost of capital. Importantly, it is dictated by the external market and not by management. The weighted average cost of capital represents the minimum return that a company must earn on an existing asset based to satisfy its creditor, owners, and other providers of capital, or they will invest elsewhere. Sometimes country risk premium or sovereign risk is included in weighted average cost of capital. This practice is usually applicable for investing in high-risk countries such as African country, where is potential business disruption due to change of law or even war. Portfolio investment. The portfolio investment are invest in the form of a group portfolio of asset, including transaction in equity, securities such as common stock, and debt securities such as bank notes, bond, and debt. It can be on group equities or combined with other securities. The goal is to diversify the investment and managing risk of investment. By investing in number of portfolio, it is expected to reduce total risk of investment. And first is expected return, the return expected from investment of securities. Second is actual return, the actual return that investment generates over a period of time. It can be 1 year or it can be 1 week. And required return, the required return is the amount of return you expected, usually after that includes the risk of the investment you expect. The return. And next is return versus risk. It means the return has a risk embedded to it. The higher the risk, the higher the return is required to make the investment justified. Next is portfolio combination. It's the combination of several invested securities in order to achieve required return of the acceptable risk factor of its securities. And correlation is the index of ratio indicates how one securities affect other securities. If the correlation is 1, it means the securities has perfect correlation, meaning the declining price of one securities will be followed by declining or increase of the same amount. And last is diversification. Is a method where you diversify the investment to several securities to achieve the required return and it is acceptable risk. Capital structure. Capital structure refers to the blend of debt and equity a company uses to fund and finance its operation. If company A has completed an initial public offering and bond offering, we could therefore say that company as a capital structure includes debt and equity. First, balance sheet. Balance sheet consists the company's asset, liabilities, equity, and measure the reported at end of period. And second is capital structure theory. We learn in Modigliani and Miller. It's assumed that if there is no tax deductibility on loan interest payment, then the optional capital structure is 100% debt. It also assumes that no transaction cost, no tax, borrowing is riskless, and debt does not affect operation. All equity firm, it means the company using 100% equity to finance its operation. Levered firms, it means the company is using a certain percentage of debt or loan to finance its operation in addition to using its equity. High levered firms is the company use mostly debt or loan to finance its operation. The higher the debt, the riskier the company as loan needs to be paid regardless how much profit generated, unlike equity only be paid by dividend when the company has profit. And factor that determine capital structure is profitability. The higher the profit, the more bankable for company to get loaned. The bank will not lend to loss-making company. Tax rate. Tax rate is play important part in capital structure because interest payment on loan is deductible while dividend is not tax deductible. Therefore, company can enjoy tax shield and saving its has debt. Volatility of cash flow. The higher volatility of cash flow making the financial risk of the company also high, making it more difficult to get loan from bank or investor. Credit rating. Credit rating represents the quality of the company. Usually agencies like Payfindo, Moody's do a credit rating based on requests of the company when intend to issue financing using bonds. Corporate restructuring. When the company faces financial difficulties such as unable to pay its obligation or liabilities including suppliers liabilities or bank liabilities, the company needs to undergo corporate restructuring. First outcome of financial distress is turnaround opportunity restructuring, asset, operation, financial, file for bankruptcy, and private workout. Surviving and transforming business. Stop the bleeding. The company needs to find a way to limit outgoing cash flow so it can be the same amount as incoming cash flow. This can be a way of stop paying dividend, paying unnecessary expense. Financial restriction. In distress company, the lenders usually restrict the usage of existing company cash. The lenders usually approve what kind of payment is allowed. Temporary pivoting. Temporary pivoting is where the management is taken over by outside parties assigned by lenders. Strategic realigning is where the company's strategy is reviewed and realigned to improve the performance. Redefine new core business. This means the company may cut or stop doing business in a core business, which is divestment of property business of oil and gas company. New ways of doing business, it means even be changed by lender. For example, from manufacturing to become trading company. Restructuring corporate structure. The way to restructure the company from financial perspective is to restructure below items. First, capital structure. Improvement of capital structure can be borrowing more or asking the shareholder to inject equity to finance its operation. Working capital management. Asset structure may include divestment of non-core assets to get more cash of the company. Revenue management is the way to increase revenue of its existing business. Cost management can be cutting costs that deem unnecessary. Cash flow management to improve the incoming cash flow or to use more supplies to finance its operation. Growth management represents strategy to improve of the company's growth of revenue. The company can be used BCG metrics to assess where it can grow the business or what business it needs to divest. Risk management by installing better risk management practice in the company. Value creation, lower weighted average cost of capital. When intend to manage value creation for invested asset, the company needs to look at its weighted average cost of capital. The lower the weighted average cost of capital, the higher the perceived return it can get. New management. Installing new management may improve the company financial and operational performance and also gain trust from investors or lenders. Tax benefits is the benefits the company can get from tax-deductible expenses such as interest payment, prior year tax losses. Reductions of too much free cash flow. Sitting on too much cash is sometimes not good for the financial structure of the company. The free cash flow can be invested in more higher return on investment from such buying bond. Conglomerate discount. By being a conglomerate, usually enjoy discount of lending interest rate. Fraud risk management. Occupational fraud and abuse or corruption. Asset misappropriation and fraudulent statement. Fraud triangle are opportunity, perceived pressure and rationalization. Whistleblowing system is a system where reporting of misconduct of management can be channeled. 4 types of incentive are physical, monetary, social, and moral that usually are the source of fraud. Issues in finance. We learn with watching movies. And so these couple examples about issue in finance regarding the movie is about corporate embezzlement, leveraged buyout, and insider trading, and Ponzi scheme. These all example of greed, lack of ethical standard, and fraud. Dividend. Dividend is basically expected return of the investor when they purchase share of a company. The return can be get from the capital gain when the price increase or dividend paid by the company. Those are affected by whether the company is making profitable capital investment, whether they pay the dividend that is subject to the company dividend policy. International finance. International finance is environment that affecting the company in various ways. For example, foreign exchange market will affect whether the company their financial in foreign exchange, whether they can incur foreign exchange gain or losses. Currency future and option market, whether the company can do hedging on their foreign exposure by do a currency future contract or corporate option. Arbitrage strategies is a form of hedging strategy. International arbitrage is a tool where the company can do a hedging with other foreign counterpart, facilitated either by bank or by themselves. Next is event analysis. In corporate finance class, we learn about event analysis of company IPO in 2021, which is my group chose Chimori. And from event analysis of Chimori IPO in 2021, we learn about analysis of IPO, macro and microeconomic analysis, industry analysis and trend, financial and valuation, and post-IPO event. Portfolio performance evaluation. In corporate finance class, we learn about investment simulation. And we bought some shares, which is I choose Astra Agrolestari shares, Ali, when they just paid their dividend and making the price is high. During the investment period, Ali's share price declined due to several aspects such as pandemic, demand for CPO despite the CPO increase, and issues of La Nina hurricane that may affect of Ali in 2022. However, from the fundamental point of view, Ali is quite strong in their financial ratios, the management, good ethical standard, and also the highest fresh fruit punch compared to its competitor. Therefore, from the valuation perspective that I make, the share price should be around 20,000, which is it's the share price in previous years.
That's all my corporate finance mind mapping. Yes. Please leave me a like and subscribe if you like my video, and see you in the next video. Thank you.